March 31 is the final deadline for making tax-saving investments for this year. If you're thinking of buying insurance, think of buying term insurance first. And if you have dependents whose financial lives could be thrown into turmoil in your absence, then there is all the more reason to buy term insurance. In a detailed conversation with Business Standard, Satishwar Balakrishnan, Managing Director and Chief Executive Officer, Aegon Life Insurance, discusses the when, the why, and how much of term insurance to buy. Do watch this interview to learn the nitty-gritty of purchasing a term plan. Thank you for joining our show. Since we are in the midst of the tax saving season, a lot of people buy insurance at this point of time. We thought it would be very timely to have a discussion around term insurance, the most important form of insurance in our view. My first question to you is, when people typically start out in their careers, they have lesser surpluses and they are in a greater hurry to accumulate assets. A car perhaps is higher on the priority list than life insurance. In your view, how early in life should a person buy term insurance?
A very, very apt question. And I kind of echo that urge to have your own first car. I can again relate back to my own days, right? So that always kind of, in fact, for me, it was more a two-wheeler and to be more specific, a bike. So that's always kind of a dream, right? But having said that, so see, insurance specifically, a term insurance, is something that you buy for your loved ones. Okay? This is one product where if I am buying a term insurance, I can't take the benefit of it. Right? It's more, the benefit is actually for my dependents or my loved ones. So that's the core of a term insurance policy. In such scenario, so what I need to do first thing is to figure out, are there people who are dependent on me, right? And to that extent, it becomes a little personal for each one of us to identify. And at the early stage of the career, it's not just dependents who are dependent on my earnings. For example, if I am a student, right? If I am a student, there is a lot of investment which is kind of especially for higher studies, where a loan would have been taken on the specific education which I am getting into. Or there is personal investments from my parents would have gone into that. So there is kind of personal savings of theirs which would have got into it. So even at that scenario, it comes. So from that perspective is where each and every individual will have to think through in terms of who are those dependents for whom this income of mine is going to be critical, right? And accordingly take that call. So yes, the urge to have and accumulate assets, of course, yes. But first thing I would seriously suggest is to have one, a term insurance policy, and two, a health insurance policy. I think these are the two critical ones which somebody should have immediately. And it can even be before you actually start earning. So that's where, so that's the reason also why you have term insurance policies even at an younger age, right? That's how the purpose of a term insurance for somebody who's still not started earning comes in the picture.
Yes, so most of us thought that you should buy a term insurance only when you start earning. But perhaps what you're alluding to is that in this day and age, parents spend a lot of money on higher education. They send children abroad, and that involves expenses running into lakhs and lakhs of rupees. So perhaps it is better to get insured even at that stage if you have a huge loan riding on you.
So the easiest question which I need to answer in case is, suppose if I die, okay, who all are going to face financial turmoil? If my near and dear ones are going to actually face financial issues and financial concerns if I die, I should insure myself to take care of that.
And what are the benefits of buying term insurance early?
Oh, there are quite a good ones, right? So one is The biggest benefit is you or I, for that matter, I will you start using the word I because term. I've kind of learned this with a lot of period because it's a matter of death, right? So you becomes a little difficult. So I've started using I over there. The first thing is when I take a term insurance, I at least have secured my dependents or my family members from the turmoil of having a financial uh, pain in case I am not there, right? So that's the biggest benefit. The other benefits which comes along with that is because if I start early, the premium that I pay on an annual basis, it way too lesser than what I would do at a later stage, right? Plus, in the initial years, you also get a multiple which is high. So every insurance company will have a multiple to the earnings that you have, right? So that also is higher in the initial stage. But the biggest benefit, which I say, which I see in buying early or getting started early, is a lower premium, and also the health conditions and all those things are much better. So the uncertainties of future in terms of having some health issues creeping in, that is also taken care of when you actually start early.
How much term insurance should a person typically buy? How does one go about deciding that?
So there's one is a longer or kind of a detailed process where one individual will have to study what are his current liabilities and what is his future revenue potential and these various pieces. The other one, which is an easier one, is a rule of thumb of at least 10 times the annual revenue of yours. Okay. Now, where are we coming in? So for an individual to decide how do we do that is I would seriously urge everyone to have the loan cover done along with when they take a loan so that that is kind of handled independently. And the other one is your term insurance policy is actually an income replacement. Right? So suppose if I die, the revenue which I or the income which I used to get regularly, this is my salary or my business, right? So that will stop coming from the time I'm not there. So this needs to be replaced with some other form of income. I know if I die, my family will naturally have a lot of emotional drain, but at least there should be no financial inconvenience to them. So it's an income replacement, and people take time to come out of that, right? For example, my kiddo will take some time to get into that kind of a age where she can start earning on her own. So all those period is where the family should not suffer because of financial constraints, right? So my kiddo's education should not suffer. My spouse should be able to manage uh, the lifestyle which they are used to. My parents should be able to manage the lifestyle which they are used to, right? So that should continue. So that is where how much cover is something which normally it's roughly taken as a 10 time, but it also depends on your age. A simple formula which I would suggest is basically suppose a normal age up to which you will work is say age 60, right? So 60 minus your current age into your current earnings is what I would suggest. So that's more simple. But in case of if you're not able to calculate it, 10 times comes in easy because you also need to rebalance it, say, few years down the line based on what you're currently earning at that point in time, based on the life stage changes.
And should one buy one large cover or should one break it up into smaller covers? What would your suggestion be?
There is no specific benefit in either, in the sense they are neutral to each other. What I would do is more studying, say, once in 5 years on what is your term cover, whereas what is your current position in terms of your financial ability. Okay. And the more you are growing in age, you should also take into consideration the current financial assets that you have created. For example, uh, in our latest term product, we have an exit option at age 55. Now, how does that work, right? So I'm buying a policy all the way up to till age 70 or age 65 or age 60, but there is an exit option at 55. The reason why we have brought in is basically it's if you look at insurance, insurance is a risk mitigator. It should replace the earning which I would have otherwise brought. Where also in parallel, I am supposed to build a corpus, right? Supposed to build a corpus for my retirement. So if you have created enough corpus for yourself, you don't need a term cover, right? Because the corpus is going to take the intent of having a term cover is because you've not yet created the corpus. And if something happens to me suddenly, the corpus is not available, but this money comes in, which takes care of that. So if you have already created a corpus, then you don't need it. And that was the exact reason why we got this exit option. This also works why we should start early is because you have not yet created a corpus. So something happens to me this whole next or whatever number of years is something where this income will not be available to my dependents. Can I actually make good for that? That's where you start early. And with respect to your question of whether one big one or multiple small ones, my suggestion would be to start with let it be an appropriate one in terms of your age and your current stature in terms of financial aspect, right? In terms of your current income. So that is what you should immediately replace. But do a check, say every 5 years or 7 years, to figure out what does my cover have, what's the corpus that we have created, and what the gap is. And to that extent, the gap has to be refilled. So that's how I would look at it. So one versus many doesn't matter.
What are the key life events that require a boost in cover?
First is, as you said, any liability because of me, not necessarily on me. Okay. For example, when I said education loan, right, it's because of me. Might be my parents who might have actually given all the assurity or surety to it, but it is because of me. So that's one. Similarly, when I start working, right, I've started making money, which means that this money, one, of course, it's for myself, but naturally there are some near and dear ones who are also dependent on my earnings. So that's another life event. Three is assuming that it should have already started at this stage itself, and we haven't done that. For example, when I get married, right? Now there is again a dependent who has come into my life. So that's another stage where I should revalidate what my current cover is and what should it be going for. Similarly, when I'm a parent, right? This is again a major life stage, which kind of triggers for you to kind of check what's the insurance cover that you have. So it's basically coming back to check continuously on a regular basis. Not I'm saying on a daily basis, but on a regular basis, saying how much are my dependents dependent on me in terms of financials. Check that what is that I have created as an asset for them in case if I am not there. And the balance has to be bridged. So every trigger, such triggers basically has an element getting created. For example, your marriage, my becoming a parent, right? So those are the pieces those are the life stage changes which we should initially trigger. And this normally happens at the early stage of your career. So this all happens before you actually reach the mid-age. And by the time you reach mid-age, I think your cover should have maximized and you should start building a corpus which should start compensating for the gap in future. So it's important that you parallelly start creating a corpus.
And perhaps also when you take a big home loan, I think that is one big liability that would require a term cover.
Absolutely. So in fact, what I said is, my suggestion is a loan cover is something that I would suggest. So every time you take a loan, irrespective of small or long, right, small or large, you should try and back it up with an attached cover in itself, so that that's independently taken care of. And this term is a pure income replacement. So liability cover is one, which was my original suggestions, as in when you take a loan, take a loan cover along with that. If something happens to me, the loan burden is not on my family. So we can keep that independent. If I have not done that, I should definitely take that into consideration in my term policy.
And how long should the duration of the cover be? When should the cover terminate?
So as I said, life insurance is a risk mitigant tool, and it is ideally, or it is used as an income replacement product, right? So my guess of up to what age will I be working, up to what age I will be earning, that's the age for up to which you should take a cover. In a simple balance, normally what we take is up to age 60, but you can all the way go up to age 65 and 70 with longevity increasing. I might actually work a little longer than what I used to earlier, right? So you can go all the way from age 60 or up to age 70. Some of the people might even also, the new trend which I have seen is to actually start thinking of retiring early. But my suggestion would be, because that's something which is aspirational and you should do. In fact, in the current scenario, retire early is actually taking an independent, what do you say, uh, not retire and stop earning. It's retirement is now kind of linked with doing something which you're more passionate about, and that can also have an earning component in it. So ideally, I would suggest take a cover up to age 60, 65, 70 based on what you think is the age up to which you will keep earning, right? That's the age up to which we should take a cover.
Nowadays, people also talk about using life insurance plans, including term cover for succession planning. A lot of people think of taking a cover till the age of 90 or 100. And if you pass away, then you get us, the nominees get a sum insured. So that is one way of kind of transferring money to the next generation. Would you agree with that approach? What do you think of that approach?
See, it's not an agree versus disagree. Okay, I would not get into that kind, because my personal beliefs can be different from what you might think or somebody else will think, right? And it's a thought. People want to have it as a legacy to be left. It's a very valid thought, and that can really come. If a product allows, of course, why should I, right? So that's another way. If I as a personal uh, individual have that kind of an urge, and if there is a product available to do that, I should take that. The piece is, when an insurance company prices such product, they are also aware of saying this is the outgo. Naturally, the things have been taken into consideration when you design a product, and accordingly, the price will also be done. So the price, for example, if you want to take a cover up to age 60, will be much lesser than the cover that you would want to take up to age 99, right? Because it has to be factored in. So that's the one. So it's more a personal choice. I want to leave a legacy. There is a product available. I can afford the premium. I should do that.
So many insurers are offering term insurance today. How does one decide which insurer to go with? What are some of the parameters to use?
See, it's the entire insurance industry, or each and every individual insurance company, is very well regulated within the insurance regulation. And this is the reason why, because it's a long-term contract. It needs to be well regulated. And the insurance company, kind of the insurance regulation, kind of ensures that when the commitment which has been given, that will be met from each and every insurance company, right? So there is a very continuous watch around the solvency ratio. And it's not just the payout happens and that's where the accounting or the liability gets created. So based on various workings, you also maintain to kind of keep a liability in terms of in the balance sheet of what can be the outgo and what that needs to be maintained at all point in time, and accordingly assets which are earmarked towards that liability. And that ratio is what is called as the solvency ratio, which ensures that each and every insurance company who is solvent has adequate assets to take care of the claims payout. And this is well regulated. So from that perspective, I think all insurance companies are pretty neutral. What I would specifically ask somebody to watch out for is the claim settlement ratio. Though we are very sure that any repudiation or any rejection which happens, those have very, very valid reasons, right? So it's not that anybody can decide to repudiate something. Those are very valid reasons based on which the repudiation or rejections are done. So from that perspective, it's there. But still, generally, what are the basis, the underwriting processes which an insurance company has applied, those things, the claim settlement ratio is a reflection of that process working. Because it's always a balancing act in terms of how stringent or how liberal would you want to go on an underwriting process, right? Stringent makes it a little difficult from a journey perspective, the process of buying. And that at times can be very painful, right? So that's the reason why there is a balancing act which an insurance company does. And that's where the claim settlement ratio kind of gives you the comfort saying the underwriting has been stringent enough to ensure that nothing kind of gets questioned at the claim stage. And that's where the claim settlement ratio kind of gives you a flavor around it. But my piece of advice in this case is whichever insurance company you choose, uh, the the overall solvency ratio and the regulation ensures that the company is financially always kept at that kind of levels to ensure that any claim payout whenever it happens. For example, when COVID happened, all the insurance companies were able to meet that sudden surge in the payouts, right? And for example, for us itself, we had claims which were 4 times the normal one. So that kind of surge happened, but each and every insurance company accordingly were able to meet that. So that is kind of taken care of. The advice which I would want to give in this case is more than the insurance company, is you personally fill in the application form. So because that's where the contract, right? And that's the reason why it's called as an application, and it's the customer who is applying for a life insurance contract, and there is a declarations which are done. So it's important that it's being done personally and very truthfully. And again, which is what you're aware of. So something which I am aware of, that is what I need to disclose on those bases. So that becomes very relevant. So this is my only advice, saying that specific application to be done personally and very truthfully. Basis which the claim settlement is a certainty. It can be rejected or reputed only when there is a non-disclosure. So to that extent, I would advise to be very truthful and do it personally when you fill up an application form.
How much should the minimum claim settlement ratio be?
There is no standard piece. So that's what I'm saying. So if you ask me saying the claim settlement ratio is bad, so all this, no, so that's not a practice which any insurance company will follow. It's more to do with I can assure you all those rejects which would have happened, they would have happened because of a non-disclosure. And these are very simple questions. These are again not very complex jargons in the application form. Over the year, the insurance industry has evolved in terms of asking simple and minimal questions which are very relevant. And the repudiation or rejection reason never goes beyond those. So these are now very simple. And that's the reason I'm saying, and I can assure you, any of the rejects will be because of either a modified intent or a non-disclosure. There is no third reason. So everybody can, each one of us can be very sure about 100% claim settlement in case if it happens, if we have been very truthful at the application stages.
So basically, you have given us two numbers. One is look at the solvency ratio to ensure that the insurance company is strong, in good shape. Another is look at the claim settlement ratio. What are the typical?
Where I'm coming from is on the solvency ratio bit. Okay, see, by default, every insurance company will be solvent because the regulation ensures that we are solvent at any stage. So very high solvency ratio doesn't really give you an additional kind of comfort or something like that. And somewhere, because just during the journey, it might come closer to the minimum, but it will again go up because the capital infusions can happen at various different stages. So, but everybody can stay assured that because the company exists and they are doing new business, it is a solvent organization. And from that regulatory purposes, that's strong. And that's the reason I said solvency ratio per se is controlled through the regulation itself. So you need not specifically check for it, but it doesn't, and every company does disclose it. So you can always have a look at it. But by default, they're all solvent. So that's the point which I wanted to make, and that's the reason I didn't come as a check. But just generally from a practice perspective, is where the claim settlement ratio comes in. And also to some extent the amount settlement ratio. It's more to do with it's a classification in terms of, for example, for us both the claim settlement ratio as well as the amount settlement ratio is 99% plus, and it has always been that. And we have a major component of term product than savings. So all put together, that's something which we are very proud of. But it's having said that, it's more to do with, I'm saying, the underwriting stage, be very diligent, do it yourself, and be very truthful.
What are some of the typical reasons that lead to claim rejection? Where do people go wrong on that count? Because that leads to claim rejection.
See, it's largely because of non-disclosures. Okay. And that is called as repudiation.
For
And
instance, what
rejections
kind of
are, yeah. And rejections are largely when if it's a mollified intent. For example, impersonation. Right? So, or a deathbed case getting insured. You currently have cartels which actually work behind the scenes to create all those documentation which people can get kind of misled. And so then when you do a very detailed investigation at the claim stage on the ground, that's when you realize that this has been a fraud has been committed. So that's one of the major reasons why rejections happen. For example, we had cases where a death man had been insured, or at least so the man had already died, and immediately after that is when they were trying to get that policy done. Or a deathbed case, which is another major piece. Which so there are these cartels which actually are on lookout for people who are about into a very critical stage. So those are the and this doesn't work, right? Because the entire piece of a life insurance is at most good faith, right? And that's so these are the reasons when a reject can happen. Repudiations can be on account of a non-disclosure. I have a health issue, right? And I am aware of it, but I don't disclose. Now this again, not because of any trivial reasons, right? Like I had cold and flu or something like that. No, not that one. But I am aware of some major issues. For example, I am aware of a BP issue to myself, or I had just got an angioplasty done, right? So various other pieces. So, or I am in a very early stage of cancer. So those are those various such pieces, largely health related issues, and also at times financial related issues. As I said, the term policy is an income replacement. So I am currently earning, say, a lakh rupee a month. Okay. But I am asking for a 5 crore cover. Such scenarios is also and naturally, no insurance company will provide in case if I have declared only 5 lakh. Now to get a kind of a 5 crore cover, I will declare my income as 50 lakh, 60 lakh rupees. Now this is again a misrepresentation, right, or a wrong disclosure. Now these are the scenarios which because you can't do a very detailed field level investigation at the policy application stage, because those are too many cases. The customers will have to wait for a very long time. And such cases then get investigated at the claim stage. And when such cases come in, that's when the repudiation happens. So majorly non-disclosures could be on account of health, could be on account of even income.
which riders do you think are most important?
Oh, all of them. I would seriously suggest all of them. So let it be, say, an accidental death cover, because accidents are remote if it happens. And extra money available makes a lot of sense. A waiver of premium cover, right? So something critical happens to me, basis which I might have to sit at home. At such time, the waiver of premium can happen. Uh, a premium holiday, which also helps. For some, I took a sabbatical, or for some strange reason, I am out of work, but my policy can still cover, right? Still continue. So that's where waiver of premium. My personal favorite is the critical illness cover. And I've actually, why it is, the favorite is not the right word because it's associated with critical illness. But I would seriously suggest everyone to have it is because we have seen cases. Okay, we have seen cases where uh, people have gone into, we specifically had requests coming in saying, I'm going through this exercise. Can you, or going through this major illness, can you prepone the death claim amount to this? Because there was no enough money to take care of the uh, what do you say, the medical expenses. So so though you might have uh, a health cover which you would have created, right? But whenever such thing happens, there are a lot of associated expenses which also comes along. So the exact hospital bill might be taken care of by the health insurance policy. But these extra expenses which comes through at this stage, because you need a lot of help and support to be created at that point in time. So that time is when the critical illness cover hits. So my personal recommendation, if you have to choose one amongst the rest, will be the critical illness.
And how should one decide on the premium payment term? Should one go for a single premium, or should one go for a limited premium payment term, or should one pay throughout the life of the policy? How should one make this decision?
So this is again depending on individual's personal financial status, right? So because your single premium for a term cover will be pretty big, so it can actually impact the financial cash flow of an individual at that point in time. Limited pay versus regular pay, it's again what do you want to do, in the sense if you want to get done with it early and continue with it for a long time, then limited pay. Because for example, if I want to cover till age 70, but I have a plan to retire by age 50, right? So I might want to have a limited pay up to age 50, but the cover to continue. Because post 50, I have an intent to do something on my own. It's not that I don't want to work, but I want to do something on my own. So these are the considerations which should be taken into while you're deciding on the payment terms. If I am very clearly going to work all the way till age 60 and those things, then I will go for a regular pay. So it's not saying one piece which fits everybody. Rather, it's more based on my individual consideration and aspects, which decides on the payment. So if I am going to be very regular, want to work all the way till age 65, 70, I should continue paying the regular premium. Because this is, again, as I said, it's a risk mitigant tool. So you pay for every year, accordingly the premium is also much lesser.
I have finished with my questions. Is there any piece of advice with which you would like to leave our viewers? Any final words?
So one is, I will repeat. So while you're applying, take it early. If you have dependence on you, or if I have created a financial bearing on my dependents, though I might have not started earning, right? The student scenario which I spoke about, get a cover ASAP. Two is do it yourself. When I say not necessarily a direct buying, you can always take advice, but the application form filling is something which I would sincerely urge each and every applicant to go through it personally before they sign it off. And third is keep the policy active. So it's very important that you pay those premiums on regular as and when the due date happens, right? So it's very important that you keep it alive, you keep it active. Don't let the policy lapse. Okay, and because and that hurts even as an insurance company. It actually hurts when somebody we have to kind of say no to a claim when it was in the lapse status, right? So so it's always important that you keep it active. It also helps because insurance companies has this option to get an underwriting done again if the lapsation happens beyond a specific period of time, right? So that again comes into the picture. So it's important that you keep it active. So start early, fill it yourself, go through the application form in detail, because that is the those are the declarations that each and every individual applicant does. So that kind of is very critical, because if that's truthful, real, accurate to the best of my knowledge, which I'm aware of, there is no way that a claim can get either repudiated or rejected. And third is keep the policy active throughout, unless you want to consciously stop the policy. For example, I've created enough corpus, now I don't need a term. In that such cases is when you should make it inactive. But don't miss the due dates and let the policy lapse.
Thank you very much, sir. With the tax saving season in full swing, I'm sure watching this video will help a lot of people who are going to make the purchase decision within the next few days. Thank you very much and have a good day.
Thank you very much. Thanks a lot, Sanjay.
Goodbye.